All right. Today is Sunday, August 13th, and this is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight, so let's not waste any more time because we have a lot to talk about here. We begin with the Wall of Hope, aka the Wall of Crap, because the moment you demolish all of these hopes of China reopening, soft landing in the economy because central banks back off their tightening campaign, and of course the promise of AI. If all of these three are broken, then we're going to go down like you've never seen before. All of this so-called bull market rally will come down crapping in a few weeks. Poof, gone, everything. And we all know that the promise of China reopening has been disappointing. And in fact, what we see in China is nothing short of stagnation. Perhaps the beginnings of a lost decade in China. And think about all of the growth that we've gotten here in this country because of cheap labor from China. Well, all of that growth and expansion in margins for corporate America, if China goes bust, it's too big to fail. And our companies will go bust too. And what do we got this week? More and more bad news from China. The headline from the New York Times says China's stalling economy puts the world on notice. The largest consumer in the world. And this country is now in stagnation. So how do we explain the delusional optimism that we see in the economies of countries that are highly dependent on China, such as the US and Germany? It just doesn't add up, folks. And I want to talk about this whole soft landing and the Fed pivot and all of that in a minute, but let's talk about AI first. Currently in the stock market, we have three manias. Two of them are tangible. One is fake, at least for now. Mania number one is the weight loss mania led by Ozempic and Wegovy. If you look at the stocks of NVO, for example, Novo Nordisk, it's at all-time highs, and the valuation of the stock actually exceeds the GDP of the country it comes from, Denmark. Does it make sense? The answer is not really. But at the same time, if you look at the company's earnings, you can see tangible results, increases in sales dramatically. The prescriptions for Wegovy skyrocketing. So you can see the results right now. There is no promise, in the future so-and-so is going to happen. No, it's happening right now. And the other mania is the construction mania. And this is the one that yours truly got to catch. Missed out in the AI and the weight loss manias. But when you look at the construction mania, look at stocks such as Martin Marietta or Vulcan or Granger or Owens Corning, Bacon Roofing. All of these construction stocks are surging significantly higher. Even the home builder stocks such as Lennar, D.R. Horton, they're all shooting up higher, although I don't see the tangible results there. But all in all, you can back up this mania by looking at the fiscal policy and the construction spending in this country, which is skyrocketing with no stop in sight right now. So we can say, the stocks of Martin Marietta or Vulcan or Owens Corning are shooting up significantly higher, but there is something to back that up. When we look at the AI mania, we have seen earnings from many companies that claim that they're working on AI or there happen to be AI companies, but all of these are not tangible right now. All of these are just promises that in the future so-and-so would happen. So you got to buy the stock right now. And this is how bubbles form, based on FOMO with the premise that in the future something will happen. And now you can see that valuations have gotten out of whack. The headline reads, NVIDIA's AI-driven stock surge pushed earnings multiple 3 times higher than Tesla. When we look at the price-to-sales ratios, NVIDIA is the largest bubble this century so far. Bigger than the dot-com bubble, bigger than Cisco back then. We've only seen these kind of multiples before the 1929 crash and the Great Depression. So this is extremely alarming. Either NVIDIA is going to put up big or it's going to shut up and shut down the market entirely with it. We'll look at the stock of Apple, for example, the largest stock in the world. It has made 3 recent all-time highs in the last 3 years. In 21, the revenue growth for the company was 36.43%. When the stock made a high in 22, the revenue growth for the company was a positive 1.87%. This time around, in 23, we have made an all-time high in Apple, yet the revenue growth is actually negative 1.4%. Does this make sense to anybody at all? The answer is absolutely not. It is a multiple expansion rally. Once you expose all of these hopes and promises to be fake, the bubble comes down crashing. And when you look at Apple's sales across the globe, they're moving down. In Asia Pacific, Japan, China, Europe, Americas. So what are we jerking off to here? Why does Apple deserve to be trading at all-time highs based on these results? The answer is because of the promise of AI and the promise of, its safety, and the FOMO rally based on the hype by the media that this is a bull market, which is not. It's a bullshit market. And now it's being exposed. I mean, all of this mania happened because we've gotten extremely bullish in the last few weeks. things gotten out of hand. The rally was driven by sentiment, not by fundamentals. And that's how you know this is a bubble, not a true bull market. Now we go back to the wall of hope. And what about the promise of, the Fed is going to pivot and we will see soft landing in the economy? Did the CPI, as I said in the previous video, did the CPI ruin the party? The answer is not really. It keeps this hope alive for now, but we're running out of time. What am I talking about? We got the PPI on Friday, and here it is. U.S. wholesale prices, surprise to the upside in July, PPI shows. Higher than expected increase fueled by the service sector. And most ironically, here it is. Surprise rise in U.S. producer prices in July, PPI, was caused by a jump in the stock market. So again, the message to Mr. Powell is, you want to control inflation? You can't have a stock market in mania mode. You can't have your cake and eat it too. The stock market has to suffer for inflation to be eradicated, whether you like it or not. And of course, it all comes down to the September meeting. Now, the market, even after the CPI and the PPI, still expects the Fed not to raise in September. Anything between now and then, anything that challenges this narrative and perhaps push the Fed to raise rates by 25 basis points or more in the September meeting will be a shock to the stock market. And it will cause a big drop down. It could be as big as 5% in a single day in the Qs, could be as big as 8 to 10% in a single day. If anything comes out challenging the premise that the Fed will not raise rates in September. Now, you got San Francisco Fed Daily. She comes out and says, we got more work to do here to get inflation back down. But she wouldn't say if she's going to raise rates in September or not. You know why? Because they're not in charge. Inflation is. And you want to get it right now? They're going to have to raise rates in September. I'll show you why. But before that, some good news. Here it is from the University of Michigan after the massive campaign of brainwashing that the inflation is going down. It's just imaginary. When you go to the grocery store and you're paying an arm and a leg at the cashier, you're just imagining all of that. It's in your head. So no wonder why we see consumers see substantial improvement in the economy over the past 3 months. University of Michigan says, we'll see how they're going to feel a few months from now. Because here's the catch, folks, and we said in this channel that the last reading of the CPI, not the one that we got this week, but the one before that, was the bottom. And the reason is we're only down to 3% because statistical manipulation, known as the base effects. Now, when I say manipulation, I don't mean that somebody's putting their thumb on the scale. Not necessarily. I'm talking about the statistical nature of how numbers work. But assuming that we keep getting similar readings, just like we gotten this week, which is CPI 0.2% month on month, by the end of the year, we'll be back closer to 4% again, if not even more than that. You see, when you look at the categories year on year, most of them are still going higher. Whether we're talking about food, whether we're talking about shelter, whether we're talking about medical care, food away from home, but we see some categories that are going down year on year, mostly energy inflation. And here's the problem. From this point on, the base effects will favor higher energy inflation. And this will cause the CPI to move higher from this point on. Unless, of course, one of these categories that are going higher right now, be it shelter, be it food, one of these categories has to come down crashing to make up for the rebound in energy inflation. But if they all continue to go higher and we see energy categories rebounding, then the CPI will start to go higher significantly. And this should be the assumption because base effects will include all of these categories, not just energy inflation. And now the base effects are actually favorable for inflation to go higher, unlike the past few months. Now, this is a basic example of how base effects work. Now, I'm not saying this is how the CPI will look like. The formula for the CPI is so complicated, and it's done by design to allow manipulation and cooking of the data. And nobody really knows how they get to these numbers. But if you look at the base effects alone, look at crude oil futures. And this is the monthly chart. All in all, if you look at the chart itself, we're paying pretty much the same prices we've been paying since 22 and 21, maybe a little higher. We got a little bit of a bump there in 22, but all in all, crude oil prices did not really go down. But look at what happens when we use the base effects. For the month of January, for example, when we look at 23 versus 22, crude oil prices were down about 10.5% year on year. Month of February, prices were down about 19.5%. The month of March, down 24% almost. April, down 26.5%. Month of May, crude oil prices were down almost 40.5% year on year. But as the base effects disappear, we go to the month of June, now crude oil prices are down by 33.5% year on year. In the month of May, they were down 40.5%. Now, in June, they're down only 33.5%. We go to July, we see that crude oil prices are down about 17% year on year. We go to the month of August. The month is still young, but assuming that we close exactly where crude oil prices are closing at right now, that would be a decline year on year of about 7.5%. Now, supposedly in the month of September, the price of crude oil closes exactly where it's trading at right now. Because of the base effects alone, crude oil inflation year on year would be a positive 4% almost. You see what's going on here? So in the next few readings, you're going to start to see the CPI moving higher. And that's because the lack of base effects alone. Not to mention, of course, that if we see actual inflation moving higher in other categories, and now we could see the CPI spiking significantly higher. And that would demolish the entire premise of, oh, the Fed's going to pause and we're going to have a soft landing, yada, yada, yada. That could happen rapidly, folks. We have Jackson Hole coming. We have the CPI for September coming. And that could change the assumption that in the FOMC meeting in September, the Fed will keep rates as it is. If we get a really shocking reading of the CPI, and the assumption is we should be. In last week's video, we talked about how energy inflation month to month in heating oil was double digits. So in crude oil, so in the gasoline bomb, so natural gas. And that's going to start to show up in the next readings. So we shouldn't be surprised to see a shocking reading of the CPI coming our way. If that happens, the market will lose a critical premise behind this rally. And then what happens to AI? Maybe AI is going to blow up before that. Maybe NVIDIA is not going to show up. And we realize that that was just a huffing and puffing operation. And they either miss out on the guidance or we find out that it is an anomaly. We've seen some demand being front-loaded by companies due to the excitement and the hype of the AI. But now we see AI spending receding. That we will see NVIDIA crashing. And if you take these down, the hype of AI and the premise of the Fed backing off and getting a soft landing in the economy, the market will come down crashing. For now, we have to assume that this is a garden variety correction, but it could morph into a crash, and the reason is this rally has been built on bullshit and a really flimsy facade, when in reality, the market has no legs to stand on. And of course, a lot of you say, hey, Maverick, you're so hot about inflation. Inflation is actually going down in my neck of the woods. And I say, look at San Diego. We look at the misery index, which is the CPI year on year plus the jobless rate. According to the misery index, the city of San Diego is the third miserable city in the United States. So maybe I feel it more than the rest of you. But of course, if you don't want to feel miserable, according to this metric right here, you should move to the city of Baltimore. Enjoy the scenery of the city and the chances that you're going to get stabbed to death for a pair of AirPods. There you go. But now let's talk about Bidenomics.
What a stupid son of a bitch.
Or Biden economics, as they say. Because there is a massive campaign right now of brainwashing, gaslighting the public, that everything is fine, inflation is going down, the economy is thriving and booming, wages are going higher, the economy is doing better than ever before. You people just love to complain about everything. That's what they're saying. And it is a recipe for political suicide by the Biden administration. If they hire me today and say, hey, what do we do with the re-election campaign, Bidenomics, what do we do with that? I would say scrap it right now, this moment, put it in the trash and flush it down the toilet. And the reason is your own economists, the yield curve, the most accurate economic indicator in history. It says that we have a 70% chance of a recession next year. The realities of the economy are absolutely horrific. And you're better off approaching the public by saying, hey, folks, we know that the CPI says that we're down to 3%. But we know that you're not feeling this in real life. We feel your pain at the grocery store. We feel your pain at the gas station, Jack. Just play politics. Play to the people's emotions. But of course, their whole strategy, every single time, not just in this case, is lie, gaslight, and brainwash. And just hope that that's going to stick. And the media, of course, is running with it. Now that inflation is rebounding, they're putting a spin on it and saying, oh, good inflation may come back later this year. And they're not talking about goods inflation. They're talking about good inflation, the good part of inflation. The fact that inflation is coming back, that's good. That's good. Bidenomics, baby. Don't be alarmed that the CPI might move higher from this point on. That's called good inflation. Here's another one. It says America's biggest brands rethink price hikes in disinflation era. What the fuck are you talking about? Another one. The Fed can take the rest of the year off as inflation is crumbling. And there is no recession in sight, says market veteran Looney Tune Ed Yardini, who never got anything right, by the way. And he's not the only government propagandist who's known as an economist, quote unquote. You got Paul Krugman. He now says, oh, there is no inflation, it's over. All what you see right now is just greedflation by the companies. Now, we covered earnings after earnings after earnings. You can see the results on your own. Inflation is not really going down in real life. Not for us consumers, and not for the corporations either. The cost is actually moving higher because of wage inflation, because of commodities prices, and because of a lot of supplier prices not really go down. So they have to make up for that by raising prices higher and higher and higher. It's a never-ending cycle, and it needs to be broken. And the only way we can break it is by raising the unemployment rate higher and allowing for a soft recession to happen. But the longer we play the game of, oh, we want our cake and eat it too, by having a soft landing, the chances of a soft recession disappears, and the chances of a hard recession becomes more likely. But keep the brainwashing going on. Here's the Washington Post. They say 5 key pillars of President Biden's economic revolution. Wow. I never thought that my life is really good right now. I need to think about it again. And then you got Tool Joy Behar on TV, of course. Here it is.
The economy is booming.
Yeah.
Inflation is down. The stock market is doing well. People are having an easier time putting bread on the table, etc. He doesn't seem to be getting the credit for that. Only 41% approval.
So she says the economy is booming. Stock market is all-time highs. My friends are all rich. Why don't they like Bidenomics? Why aren't the people really buying this bullshit? Why are we now sending Janet Yellen in a propaganda tour starting in Las Vegas, of all places, of course, to pitch Bidenomics? If Bidenomics is really working and we have an economic revolution, then it shouldn't be really sold. The public should be buying it with no complaints at all, but not even thinking at all. The polls should be really favorable toward the president's economic agenda, but they're not, and they're not for a reason. You can downplay inflation all you want. In real life, inflation is still here, and inflation is going higher and higher and higher. Meanwhile, the fundamentals of the economy are getting worse, and the consumer is getting choked by this stagflation phenomenon of higher inflation and higher rates now. So what do we see? The worst housing affordability in American history. Is this really Bidenomics? Is this a booming economy, Joy Behar? Here's the headline. Only 16% of Californians can afford to buy a home. You need $208,000 of income to qualify for a 30-year loan. So we're becoming a nation of renters, enslaved to the corporations and to our jobs. Because if we have the security of owning a home, then I'll work whatever I want to work. My home is already paid for. It's affordable. It's done. I don't have that stress that I gotta work, otherwise I'm not gonna pay the rent and I'm gonna end up being homeless. But this is the reality of the economy that we're living in. And here's the headline. 61% of Americans say that they're living paycheck to paycheck even as inflation cools. Because inflation is not really cooling. It is only statistical manipulation. In real life, inflation is going higher. Here's another headline. 70% of Americans are feeling financially stressed. 73% of Americans rank their finances as number one stress in life, according to Capital One. Again, is this really a booming economy? Is this how Bidenomics is working? What the hell are these people spunking? Do they even live in the real life that we're living in or not? And the combination of high inflation and stagnant wages, the result is that Americans will have to resort to using credit cards. And credit card debt in this country has now reached $1 trillion. Now, the interest rate is between 20 to 25%, pretty soon 30%. So we're going to pay what? $250 billion in interest payments alone every single year? Is this really a booming economy? Is this really Bidenomics? What the hell are you people talking about? And of course, when you have to use the credit cards, why are you doing that? Because your savings are now gone. We see a very dangerous phenomenon. The headline reads, Americans are still ransacking their retirement savings. We're now dipping into retirement savings to cope with this inflation. In the second quarter, the tally of folks taking hardship withdrawals from their 401k was up 12% compared to the first 3 months of the year and leapt 36% year on year, according to a new survey from BofA, which tracks about 4 million clients' employee benefit programs. Borrowing from retirement savings was also up. The percentage of 401k participants who got a loan from their workplace plan stash in the second quarter was up 2.5%, up from 1.9% in the first 3 months of the year. Experts are worried that people are beginning to treat these accounts as savings rather than retirement accounts, and may even be spurred to do more in the future due to change in the law that could end up having the opposite effect than intended. An important reminder that a withdrawal from your 401k account is typically taxed as ordinary income. Also, you'll pay a 10% early withdrawal penalty before the age 59.5, unless you meet one of the IRS exceptions. Otherwise, they come to your door with guns blazing, dogs, choppers, you know the deal. These include certain medical expenses, qualified tuition payments, and up to $10,000 for first-time buyers. Some employer plans will allow a non-hardship withdrawal. So Now we're digging into retirement savings, folks. It's insane. This is a booming economy. This is Bidenomics. To each his own. And don't forget, of course, about student loan payments. That's coming. September, October, you're going to have to pay your student loans back. That's more and more hardship. And folks, when they talk about soft landing and the CPI is down to 3%, maybe the economy is going to survive, that's bullshit at the end of the day, because this is what's happening in real life. This is a hypothetical example, of course. A lot of simplifications here, but just so you know, let's say in the base case, before inflation, you look at your income all in all, monthly income, 25% goes to housing, 10% to groceries, 8% to utilities, 2% to gas, 10% to car payment, because you got to have the BMW, otherwise people would think you're poor. Then you got 20% in savings, 20% in disposable income, and 5% in debt payment. I would say not bad, but then you look at the inflation scenario. When inflation creeps in, all of a sudden your housing costs are now up to 35% from 25%. Your grocery bills are up to 15% from 10%. Utilities now cost you 10% versus 8%. Gas costs you 5% versus 2%. Your car payment is now 15% because prices went higher. Interest rates are going higher. Your disposable income that used to be 20% is now 15% because you're not used to and you're not ready to lower your standard of living right now, so you're using your savings. So now you got zero savings. Your debt payment is still 5%, but that's about to change because inflation is moving higher. And we've already seen that consumer savings went down kaput. But the result of this kind of inflation and the pressure that workers feel in the economy is wage inflation. They demand higher wages. So in the wage inflation scenario, you get a bump in your pay. All of a sudden, look at this. Your housing costs go down from 35% to 30%. Groceries go down to 12% from 15%. Utilities go down to 8% from 10%. Gas goes down to 4 from 5. Your car payment is going to be 11% of your income now versus 15 before the wage inflation. And now you got disposable income 15%. So you're not changing any of your lifestyle right now, but you're building your savings again. You have 10% of savings up from 0, but your debt payment is now 10% because you had to rack up a bunch of debt in your credit card to cope with the inflation before you got your bump in your wages. And now that's going to cost you 10% of your income because interest rates are moving higher. Here's the problem. Wage inflation feeds more inflation. And this causes the economy to go into stagflation. And the reason is inflation is sticky, number one. Number two, rates continue to go higher, so your debt is going to cost you more. And now you have to cut down on your spending across the board. You have to start planning for a rainy day. So what happens? In the stagflation scenario, your housing costs still 30% of your income. Groceries goes down to 11% from 12 because you're cutting down, not because prices are going down. Utilities are now up again to 10% from 8, and gasoline prices are up to 5% from 4% because we have a rebound in inflation. Your car payment's still at 11%. You're not going to get a discount from that. But most importantly, your disposable income is down to 6% from 15% because now you have to pay more in servicing your debt, 15% of your income versus 10%. You see your savings going to 12% from 10% because now you're becoming more concerned about the economy. And as we see that disposable income going down and down and down, what happens? Corporate earnings will go down because folks are not really spending in the economy. Small businesses, restaurants will all see a slowdown in business. If you look at the earnings from corporations that we've gotten so far this season, the input cost is really, really high. So the moment they see a destruction in demand because of higher rates, because folks are now spending less, their disposable income is going down, what would be the result from corporate America and employers? The answer is letting go of employees. And then the unemployment rate increases higher in the economy. And we start to head into the recession scenario. Nobody's going to decrease your cost of housing or utilities or car payment, but maybe now you're going to use gas less, so that cost goes down 3% from 5%. Maybe you go on a diet and you reduce your grocery cost to 10% from 11%, but now your debt payments swell to 20% from 15% because you have to pay back your student loans and you racked all of this debt and rates continue to go higher. And you're saving for a rainy day, so your savings are up to 15% from 12%, but now you got no disposable income at all. What happens? The economy blows up in a recession because consumer spending, demand goes down crashing, and companies will have to lay off more and more employees. And then we have a recession. And this nightmare scenario that you see right here is actually for folks who end up keeping their jobs. Imagine if you lose your job and you have all of this debt. You have this insane rent that you have to continue to pay. You're going to have to move out. Your car payment, you can't keep that anymore. You have to get rid of it. And when it comes to your debt, you have to file for bankruptcy. And that's when real disinflation and deflation happens. A recession. Housing availability increases as folks have to move out. Prices go down because folks lost their jobs. They can no longer afford rents from the inflation inflation era. Car payments will go down because the Fed will have to cut rates, and the prices of cars will go down because of the increase of supplies, all of these folks who cannot really afford to keep their cars after losing their jobs. And that's the only way inflation is eradicated from the economy. But we have this fantasy called soft landing. It's not gonna happen. And the sooner we reconcile with that, the better our planning is gonna be when a rainy day actually arrives. But if we live in this fantasy that, oh, we got Bidenomics, and the Fed will fix it all, AI will fix it all, then you get caught with your pants down, and you face this dire scenario of having to lose your home, your car, file for bankruptcy. Why not be prepared right now? And that's all I'm going to say. With that, folks, let's move on to cover the market information for you. We begin with the closing of the indices last Friday, and here we go. On Friday, the Dow Industrial Average closing positive by 105.25 points, or a gain of 0.30%. The Nasdaq in the red, down by 93.14 points, or a decline of 0.68%. The S&P in the red, down by 4.78 points, or a decline of 0.11%. We look at these sectors on Friday. Number 1, capturing the gold medal, energy. And number 2 for the silver, healthcare. Number 3 for the bronze, utilities. So we see the number 1, energy, that's inflationary. Healthcare, utilities, that's more of a defensive / recessionary positioning. So maybe we have a stagflation theme on Friday. Who knows? Maybe it's going to gather steam from this point on. And then we see technology, cyclicals, and communication services at the bottom. We contrast this with the weekly performance, so let's see what's going on here. Nothing changed. Energy number 1, healthcare number 2, utilities number 3. The laggards, once again, technology, cyclicals, and this time materials. And the reason is the dollar was up this week, so metals are not going to do pretty good. Look at the breadth on Friday. Believe it or not, it was actually pretty much neutral. The NYSE 52% advancing versus 46% declining. The Nasdaq 45% advancing versus 51% declining. So from this point on Monday, the market can go either way. If it wants to rebound, it has the room for a rebound. If it wants to continue to go down, which I believe this is the case, then it also has plenty of room to go down without being oversold. We look at commodities on Friday. Muted reactions across the board, yet the US dollar continues to go higher, and this is not going to be good for metals. So we see copper down yet again about 1.25% on Friday. We see grains down across the board, led by wheat down about 1.7% on Friday alone. Softs, we have a mixed picture, a pullback in coffee, but OJ, which continues to go higher, it's a luxury at this point. Orange juice, believe it or not, is actually a luxury. Last night I went to the grocery store and I bought some orange juice, and it cost me about $6. So I decided to buy a bunch of oranges and squeeze them for myself, and that cost me actually $10. Anyways, then we see cotton up about 2%, sugar up about 2%. Decent day for softs on Friday. Then we see yet again, when you look at energy, despite the rise in the dollar, only heating oil is pulling back by about 1.25% on Friday. But we see gasoline RBOB advancing by about 1.5%. Natural gas up almost 1% on Friday. Even the WTI and Brent flattish, but be it positive. So we'll see how the resiliency of energy is going to hold as we continue to see the dollar moving higher along with yields. Now, all in all, for the week, when we look at the performance for these futures, number 1, natural gas up about 8% for the week. Gasoline RBOB up almost 6% for the week. You look at heating oil up about 1.7%. Brent, the WTI up fractionally, but again, all of these commodities are advancing. We see some commodities going down for the week, led by canola, silver, cocoa, copper, soybeans, even coffee went down. But energy commodities continue to advance, and that's going to feed into inflation in the economy. Moving on to the options market, aka the big casino, what do we see here? The answer is the volume is actually moving down a bit. It fluctuates for names such as Tesla, for example. It moved higher on Friday, so perhaps we see more activities here. And as we see the IV rank increasing, we see buying of put now eclipsing buying of calls, we could see more downside coming for Tesla. But notice that now we have more demand for puts. We're now almost at 50-50 in most names. What does that mean? We have a little more to go here in this correction, and we're going to see puts outweighing calls. You're going to see maybe 55% puts, 45 calls. We're going to get to the 60s, maybe 60% puts versus 40 calls. But the higher the ratio goes in favor of puts, the greater the likelihood that we're going to hit a rebound. So when folks, the Johnny-come-latelys, start to buy puts and stampede on buying hedges to the downside, we're going to switch sides here in this channel. We're going to bet for a rebound. Then when they start buying the dip again, assuming that this was the correction, it's over, and higher we go from this point on, we see more buying of calls, we switch to puts again, betting for more downside to come. But of course, all of this is dependent on what happens to AI. AI, what happens to the premise of soft landing. And of course, here it is. When we look at the 5 days average put to call ratio, the call options buying mania is now in the rear view mirror because we see more buying of puts. And soon enough, we're going to get closer and closer to the neutral line of 1-to-1. And if that happens, then that will be a great indicator that the market is ready for a rebound. Now, this week will be important because we have OPEX, so we have to look at the monthly expiration and see what the important numbers are. We know that the majority of the action is all about the NASDAQ and the big caps, the AI mania. So let's look at the Qs. Calls versus puts, expiration date August 18th, meaning this Friday. If you look at the calls, look at the open interest, the highest number is 365. That's in the money now. So we know that 365 is an important number. The market maker would like to make these 365 holders lose their money. And they can do that by closing the Qs at or below 365. The problem is when we look at puts, the 365 contract has about 50,000 open interest contracts. So this is why I say 365 is a pivotal point. If the market breaks below 365, the likelihood is the market maker will be sucked into a feedback loop that could take it all the way down to 360, where we can see the next highest number of open interest. If 365 is defended, then you can see more buying of calls. We can see that the next contract with the highest number of open interest is 370. So this week when it comes to Qs, it's all about the battle of 365. If the bulls win, we can go as high as 370 in the Qs. If the bears win and 365 is broken, then we can go all the way to 360 by the end of the week. When we look at the unusual activities that took place in the options market on Friday, we only have one trade here. It's a combination of a put and a call spreads, all for the expiration date of August 25th. So it's not a long-term bet, but it's on the DPST. This is the 3 times levered index for the financial ETF. So basically, if financials go higher by 1% during the day, this index goes higher by 3% during that particular day, and then it resets for the next day. You can read the trade all you want, but the bottom line here is when somebody buys a combination of a put spread and a call spread with a shorter term expiration date, what are they expecting here? They're expecting that we have a move, let's say about 10 to 15% in either direction, but they have no idea which one it's going to be. They're just betting for a big move coming in the DPST, meaning a big move in financials. From the seller's perspective, the ones selling all of these options, they see one or two things. Number one, financials will be flattish all the way till the expiration date. Or if we have a move, it's not going to be as big as 10 to 15%. It's going to be below. It's going to be maybe 5 to 6%. So this is what the sellers see. The buyer, of course, is betting on a larger move. They're just not positive about the direction of the move, and therefore they bought both call and put spreads. And when we look at the DPST's chart, what do we see here? This is the daily chart. We can see that we have resistance at around 93.71, and maybe this is why the trader bought the 94, and they sold the 96 because they believe maybe if we have a big move coming between now and the expiration date, it's going to stop at the resistance, and therefore they want the 94, and they sold the 96 because they see it as unachievable by the expiration date. When it comes to the puts, they bought the 66.5, they sold the 68.5. Well, guess what? 66.5 happens to be support. So the trader sees maybe if we see a pullback between now and the expiration date, it's going to go past 66.5, but not all the way down to 68.5. And of course, for the seller's side, they see that these ranges are going to hold. 93.71 as resistance, 66.5 as support, and the trader who bought these contracts will lose their money. Anyhow, moving on to the heat map for Friday's activities, what do we see here? Again, we can see energy advancing, we can see healthcare moving higher, but mostly because of the big pharma names. Besides that, we see some positive activities in industrials here and there, in financials, in defensives, in cyclicals here and there. But the majority of the declines on Friday came from chips, led by NVIDIA, AMD, AMAT was down about 4%. The big cap technology names were muted, Chinese names were down, while Disney lost some ground from the post-earnings gains. And all in all, we can say that we have de-risking on Friday from chips because they saw what happened to the big caps. They saw what happened to software. All of these names with AI promises in the software cohort, they came down crashing. And the example here is Upstart Holding. And then from the chip cohort, we got Super Microcomputer. That went down crashing this week by more than 20%. So now all of a sudden we have fear that maybe NVIDIA is going to bob, maybe this This is the peak for SMH and chip names that will better book profits. When we contrast this with the weekly heat map, what do we see here? You can see more pain in technology. It includes the big caps now. You got Microsoft down about 2%, Apple down about 2%, Meta down about 3%, Amazon down about 1%, Tesla down about 4.5%, with the outperformer being Google up about 1.25%. But Google is the cheapest one. Google is not at all-time highs, as we've seen Apple coming out from. It was also a painful week for financials all in all. It was a painful week for cyclicals. It was a painful week for metals. We have exceptions, of course. The gold miners, believe it or not, fared a lot better than the actual commodity gold. But with the dollar moving higher, we see the majority of steel, copper, chemical, agricultural names going down. And of course, when the dollar rebounds higher, we see some pain in the staples, because a lot of these companies are multinational companies. But they fare a lot better when we have recession fears. So we see some names such as Costco, Walmart, Coca-Cola faring a lot better. Now, of course, when we talk about healthcare, the obvious is we see the outperformance by Eli Lilly and NVO because of the weight loss mania. And now we have speculations of, who's going to be the next Eli Lilly, who's going to be the next NVO. So you see Amgen up about 8% for the week. Now folks are talking about J&J's treatment. Perhaps Pfizer will come out with something. Maybe AbbVie will do something. So we have speculation here in healthcare. And we might mistake that as, we have a recession formation in the stock market. Meanwhile, is it really a recession formation, or we have a weight loss gold rush in healthcare now? When we talk about maybe there's a rush to dividend-paying names, and this is why we see big pharmaceutical names moving higher. Is it really? When we have yields on the fixed income moving higher, if we play the devil's advocate, maybe it was a good week for healthcare because of dividends. I mean, look at what's going on with the AT&T, Verizon. Look at what's going on with the utilities, names such as Duke. Now, I disagree. I think the dividend-paying names caught a bid this week for reasons of being oversold, and we see a retreat in the 10-year. It's a tiny bit, but I think the majority of the gains from healthcare is due to the weight loss mania. So what does that leave us with? When we talk about the durability of the rally, the more it's tested and the more it survives, the stronger it is and the more durable it is. But when it comes to tech, the moment we got some test because of earnings, we see them going down. But you look at energy, for example, it has been tested by a rebound in the dollar, but energy continues to hold ground and it continues to move higher. So we know that there is a degree of durability in energy. With that being said, I still believe that we're getting overbought here. We will see a pullback in energy. But since the durability has been proven, you're better off buying the dip in energy rather than technology. And that's just my take. Now, when we look at the weekly heat map for the ETFs, what do we see here? The obvious, technology down. The biggest loser is chips, the SOXX, the SMH, all down. And when we see the dollar rebounding, we see Chinese equities going down. So we see the FXI, MCHI, emerging markets all going down. And it was a week where value outperformed. You look at large cap growth, that's down for the week. You look at mid caps, down for the week. Small caps, down for the week. But value, VTV, IWD, that's positive, barely for the week, but it is positive. Now, when we look at the defensive ETFs, such as XLU, XLP, they're positive, but barely. And this is why I say when we look at the XLV's outperformance, it's not really because we have a rush to defensives or a recession formation, but mostly because of the Wegovy mania. So we see the XLV moving higher by about 2.5%. But the action, the biggest winner, energy, XLE, XOP, OIH, natural gas, UNG, BOIL was up about 21% for the week. This is where the action is. But again, the resiliency will be tested. If the dollar continues to go higher, can energy really hold? Or are we going to start to see profit taking? At some point, it's going to happen. Question becomes when. My hunch is really soon, because I think the majority of the short-term gains in energy have been already made. Look at a chart such as MPO Marathon Petroleum. It's insanity. It's acting as an AI stock. And I own it, but when you look at a chart like this, you gotta be booking profits. You gotta be selling calls. And this action from the holders of these stocks will push them down. You see the pullback. Let's do some charts and then wrap it up. We begin with SPY, an hourly chart. What do we see here? What we see is that we've lost some ground a little bit on Friday's action, but the chart is not really oversold by any means. If it wants to go down, it can go down. And one would argue that this is a formation of a bear flag pattern. If it plays out, the chart has 443 as the next support. If that doesn't hold up, then we have 441.69. Then after that, we have 439.45. But we have to take it one step at a time. Of course, if the bulls manage to recapture 448 as support, then we can talk about, okay, this is a rebound. Maybe the correction is over and we're going to go back to the highs. But they have to recapture 448. The burden of proof all of a sudden is on the side of bulls. They have to show us that they're going to buy the dip. When we look at the daily chart for the E-mini futures, what do we see here? The answer is we got the pullback. Is it enough? Is it done? The answer is we have no indication that it is done. We look at the momentum indicators, be it the RSI or the MACD, we see negative divergences in both. We see the volume moving higher and down days. Now, the good news for the bulls is we haven't lost 4,472 as support, but who's to say that we're not going to go down and just finish all of this correction in one shot? If that is the case, what is the target here? There is a gap at around 4,300. I believe that has to be filled, and if that happens, we're going to be erasing the majority of the June and July gains, and I think that would be the outcome. If that is the case, then we go down all the way to 4,300. That'll be a downside of about 4% until we get there. Now, we have done the long-term outlook. If we go down, let's say, in a bigger correction scenario in last week's video, and I would say go back and look at that. In this video, we're going to stick to what happens in the short run. If this correction has more to go, how much? Just a correction. We're not talking about a crash. We're not talking about landmines. We're not talking about anything. In a plain vanilla correction scenario, I would say we have to go down to 4,300. That would be about 4%. But it is imperative for you to understand that this could happen in one shot or in a gradual process where we see dips being bought, rebounds, and the rebounds are sold, and we continue to go down all the way to 4,300 in a longer time frame. Why is this important? A lot of you are buying the SQQs or the inverse indices and the SPY, betting on this correction. If it happens and these indices go down to these targets, down about 4 to 5% in one shot, you're going to be rewarded. And you should be holding on these bets. But if we're going to go down to these targets in a gradual fashion, and these rebounds will kill you, especially if we have call options on these inverse indices or put options on the levered indices. So management becomes important. What do you see? Do you see it going down in one shot? Then stick to these bets. If you see it going down gradually, then the management becomes really important. You have to book your profits when the hourly RSI and these charts become really oversold, because we're going to see rebounds, and the rebounds will eat your profits away. When we look at the SPX, the cash index, the daily chart, what do we see here? We use the Bollinger Bands, which includes the 20 MA, and then we use the 50 MA, as you can see in white. What do we have here? We're pretty much at the 50 MA right now, which coincides with my support at 4,440.39. You look at the RSI, we have negative divergence, we have negative momentum in the MACD indicator. So if this support doesn't produce a rebound, then we're going to go down. We're going to go down more. And if that is the case, forget about the 50. The 100 becomes support. And if we plug in the 100 moving average, that would be a downside from this point on of about, here it is again, 4% or so. And that would be a garden variety correction after a massive run. So that would be the plain vanilla scenario. We discussed what happens if it becomes more than that in last week's video. We'll look at the weekly chart for the SPX, the cash index. What do we see here? We're looking for a revisit to the 20 MA on the weekly chart. From this point on, that would be a pullback off. Here it is again, about 4%. So all of these indicators are saying we're waiting for a 4% correction, at least from this point on. And that should finish the move, at least the first leg of this correction. And then we take it from there. Then we see what happens. We look at the Qs, an hourly chart. What do we see here? We know that 365 is a really important number. I explained to you why in the options market coverage, but you can see it here too. If this is broken, and chances say right now it will, because it forms a bear flag pattern. Why couldn't the Qs close above 367 by Friday? It means it wants to go down. And looking at the RSI, we have plenty of momentum to go down. So if 365 is lost, we have more downside coming. If it is held instead, and we see the chart going back to 370, then we know that we got a rebound in hand and we have to look for a rejection target. And we'll do that if we get there. Look at the daily chart for the continuous contract for the NASDAQ. What do we see here? It is exactly almost at the important support of 15,000. If that's broken, then we have perhaps a solid confirmation the bears are now in charge. We have a bearish trend being born. We'll look at the momentum indicators, the RSI and the MACD. They're all in negative divergences. So what do we see here if this continues? If 15,000 is broken, then we have to go down to filling the gap in or around my support of about 14,445. That'd be a downside from this point on. Here it is again, 4% or so. We look at the index, the big NASDAQ. What do we see here using the Bollinger Bands, including the 20 MA and the 50 MA? What we know is the chart is trading below all of these indicators. So we have to use the 100 MA. And if the Qs continues to flush down, the 100 days moving average becomes the target. And that will be a downside from this point on of about 5.5%. So we're looking for 4 to 5% on both the NASDAQ and the S&P. Now we'll look at the weekly chart for the index using the 20-week moving average. If that is the target we're looking at, and all indicators say that we're not finished, if you look at the RSI, it's moving down from elevated levels, and the same can be said about the MACD. If that is the case and we have more to go, then the first support I'd see is around the 20 MA on the weekly chart. That would be a downside of about 4.5%. So here it is again. Then we'll see what happens. but one step at a time. If we look at the SMH, the CHIPS Index daily chart, what do we see here? The 20 MA is already lost. We're expanding the Bollinger Bands to the downside. We have the 100 moving average. That could be the next target, and if it is, and it should be, then we're looking for a downside of about 4% from this point on. Here it is again. When we look at the IWM and hourly chart, what do we see here? It is stabilizing at around 189.75, but one would argue, if we look at the RSI, it is losing the positive divergence, maybe forming a bear flag pattern. If that is the case, then we're going to go down more. But we have to look at the daily chart for the IWM using the Bollinger Bands, the 20 and the 50 MAs, and see what's going on here. What we see is, unlike the SPY, which is flirting with the 50 days moving average, and the NASDAQ, which already lost the 50, and now we're looking at the 100, the IWM hasn't tested the 50 moving average yet. So that could be the next destination. Then we see what happens from that point on. And that would be a downside of about 1%. The problem is, if we look at the weekly chart, we have divergences outside of the upper Bollinger Bands, and every time that happened, we went down big. If we assume that we have a garden variety pullback to the home base of the chart, which is the weekly 20 moving average, that'd be a downside of, here it is again, 4.25%. Look at the Dixie. Is it outside of the range? Do we have a break? The answer is not really, but we closed at the upper range, which is around 103. So I would look at this as positive, not negative. But at some point, the dollar is going to face resistance and become overbought. And that would be at around 103.08. That's my number. And then we'll see what happens. You look at gold. It lost an important support, 1928. And we have a lot of indicators that gold should be going down more. But on the positive side, what if this is a wedge pattern and we'll see a breakout for gold, just like we've seen before? That is a possibility. The problem is, we look at the weekly chart for gold, what do we see here? It has already broken trend, number one. Number two, maybe we have a head and shoulder topping pattern. So you got to be really careful here. Look at the SLV silver. What do we see here? Consolidation, maybe in a bear flag pattern. We look at the RSI, it is diving down, but maybe finding some ground here. But again, what if it is a bear flag pattern? You look at the weekly chart for silver. If we clean up the chart a little bit, what do we see here? It's not broken trend yet, as we see in the gold example, but maybe it's going down there because we see a pattern of a head and shoulder formation. So keep that in mind. We look at UK oil, Brent oil. What do we see here in the daily chart? The answer is a decent closing above 85. But you look at the RSI, we're back again in negative divergence. You look at the MACD indicator, it's about to cross, perhaps producing negative momentum in the histogram of the MACD indicator. In other words, can we see a pullback? The answer is absolutely. Will we see a pullback? I would say certainly. If we see a pullback, if you're bullish oil, you're hoping that, sure, maybe we break 85 again, but we go back to the next support line, defending the lows, and then bouncing higher to make higher highs. That would be the bullish scenario. We have a lot of support for that if you look at the weekly chart. We are right now at resistance. It's a strong piece of resistance. If we pull back and we break above this resistance, then we have more energy to be released in this chart. It could take us back to the 90s, if not the hundreds again. We look at the 2-year yield. What do we see here? We made a higher low, and we closed above 4.87. That is bullish, not bearish. Furthermore, you look at the monthly chart for the 2-year yield. What do we have here? We have a consolidation range that goes all the way back since the 1980s. We're now at the upper range of this consolidation zone. And if the 2-year breaks out, then the next resistance would be at around 5.8%. So rates will go higher, and that will devastate the economy. You look at the 10-year yield, monthly chart this time around. We are now at multi-decades worth of resistance. And we can argue that this is a cup and handle formation. If we break out, then we have to look at 5.29 as the next support, and that will be on the 10. If that happens, the stock market becomes less and less and less attractive. And here's the 10-year yield daily chart. What do we see here? We made a higher low again. We're waiting for what? Higher high. And then we're going to talk about taking out the former highs from last year. The VIX daily chart, what do we see here? Not a good closing on Friday. Perhaps we can argue that this is a leading indicator that the market is due for a rebound. On the other hand, if we look at this from the weekly chart perspective, what do we see here? We still have positive momentum in the VIX, the volatility index, but we know that 17.08 is stiff resistance for now. But what if this is an ABC pattern in the making? You got to keep that in mind. And you might say, Maverick, you just gave us a bullish and a bearish outlook, so which one do we use here? Are you paying attention or not? It's not going to be an ABC pattern if we take the lows of last week's candle. So long as that is intact, then we have the possibility of an ABC breakout. Look at Apple, the big kahuna, an hourly chart, or 2 hours chart, what do we see here? Holding on to 177.35 as support in a bear flag pattern. What is it doing here? It is working out the oversold conditions on the RSI. Well, now it's still oversold, but not as oversold as it used to before. Yet the stock is staying at the same level here, not making higher highs at all. This is bearish consolidation, not bullish consolidation, indicating that we have more downside to come, and that could be closing the gap at 175.38. We look at the daily chart on Apple. What do we see here? It is oversold, but it is hugging the 100 days moving average for now. If it loses that, then we're going to see more energy being released to the downside and more pain coming for Apple. We're talking about all-time highs, folks. We're talking about $3 trillion just a week ago. Now we're talking about Apple at the 100 days moving average at the risk of losing this average. We look at the weekly chart for Apple. What do we see here? It closed below the 20 MA on the weekly chart. We have a confirmation on the weekly MACD that we got some bearish momentum here. You look at the red impression on the histogram, the first one this year so far. Keep that in mind. If that is the case, then sooner than later, Apple will be back down to 150. It should have never traded above 150. It was stiff resistance last year, even though the growth of the company was a lot better than it is right now. So we have to go down to 150 at a minimum, if not below. And that will be a downside from this point on of about 15.5%. We look at Tesla on hourly chart. What do we see here? The good news is it closed above 240. The bad news is it doesn't change anything at all. We haven't even closed the gap above. So we have to look at the daily chart and see what's going on here. We use the 20 and the 50 MAs. The chart is below both. So the next support becomes closing the gap at around 235. The number is actually 234.86. If that doesn't hold, then we have to look at the weekly chart for Tesla. And when you look at the 20 MA this time around for the weekly chart, that would be down about 8% from this point on. We have negative momentum in the RSI. We have negative momentum in the MACD indicator, all pointing out that this is a really legit possibility with an 8% downside, which is not even that excessive at all. If we have a true reversion to the mean, then we're going to go below 8% from this point on. And the problem for Tesla is, if we look at the monthly chart, 234.86 is a really important number, because if that's broken from a monthly chart perspective, then we got a confirmation of a head and shoulder topping pattern, and that would be a generational top, and you're not going to see these prices perhaps for years to come, maybe decades to come. Keep that in mind. Microsoft, 4 hours chart, what do we see here? It has broken trend. It retested the trend, was a failure. Now we're looking at 318.88. We can round that up to 319 and see how that goes. But the most important support, in my opinion, 327 has been already broken. Now, is there a bullish scenario, Maverick, here? The answer is yes, we do have a bullish scenario, which what if this is a bullish consolidation pattern? And we see a big breakout for Microsoft. Of course, if that happens, then we'll see a big rebound in the Qs and things will start to change. The problem is, if we zoom out a little bit and we use a daily chart, you can see that the momentum is not really oversold and has plenty of room to go to the downside. I think the chart wants to close a lot of gaps below. The chart wants to correct a lot more. If that is the case, if we go back, let's say in one shot correction, 4% all the way down the S&P to 4,300, the Qs goes down by 4.5 to 5.5%, then Microsoft will go down to closing the gap at 279.5. That'll be a downside of about 13% from this point on. But before that, we have the 100 moving average. We use the Bollinger Bands. We use the 100 days moving average. We have that as support number one. If it is broken, then we talk about closing the gap. We look at the weekly chart for Microsoft using the Bollinger Bands and the 20 MA. We're exactly at support right now, really close. We have to see how these levels are going to hold. And if they don't, then we're going to head down to closing the gap. We look at Meta. What do we see here in the weekly chart? Way overbought, in desperate need for a sizable correction here. It already erased the majority of the gains from the earnings report, and now it's trending down. Well, we have a lot of work to do here. If we clean up the chart, we use the Bollinger Bands on the weekly chart, the 20 MA, we have a downside of about, let's say, 11.5 to 12%. And that would take us at around, let's say, 250, 260. And then we see what happens with Meta. When it comes to NVIDIA, NVDA daily chart, what do we see here? You got the Bollinger Bands, we're outside that. You got the 20 MA, we lost that. You got the 50 MA, we lost that too. So the chart is changing momentum here. No doubt about it. And perhaps we've already marked the top in NVIDIA. We zoom into a 4 hours chart. What do we see here? We got plenty of damage. We lost the trend line. The bear flag played out. We lost 420 as support. And we're now waiting for 400 to be broken. Can we see rebounds before that? That's possible, of course. If the chart closes above 420, then the bulls will start to regain some momentum. But my hunch is NVIDIA is going to consolidate in or around 400 and 420 until we get the report out. If you look at the weekly chart for NVDA, assume it goes down in a mild correction from this point on. Then we have the 20 moving average, and that'll be a downside of about, let's say, 10 to 11%. And that is, of course, a modest pullback. Some folks see 50% from this point on. Some folks see 60, 70%, even 80%. I would take it one step at a time, be conservative here, and say that support number one that we see right now is the 20 MA on the weekly chart. That's about 10 to 11%, and then we see what happens. Last but not least, Bitcoin. What do we see here? At the time of the recording of this video, we don't have any breakout at all. But is the formation right now bullish or bearish? The answer is so long as it is above 29,200, then it is bullish, not bearish. But we're waiting for a breakout. If the buyers don't show up, you know the deal. The sellers are gonna. And this bullish setup for a rally, it's not gonna play out. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, we got nothing, so that could be a decent day for a rebound. Tuesday, August 15th, we have retail sales, then we have the import price index, along with the Empire State Manufacturing Survey, and of course we have business inventories and the demon from Minneapolis, Neil Kashkari, who's now becoming a dove again. We'll see. Then Wednesday, the 16th, we have housing starts, building permits, industrial production, capacity utilization, and the minutes from the last FOMC. Now Thursday, August 17th, we have initial jobless claims, we have U.S. leading economic indicators, and the Philly Fed Manufacturing Survey. Friday the 18th, we have nothing, so the market has some opportunities to rebound here Monday and then Friday, although Friday we have OPEX, so maybe when that's out of the way, we can see a rebound opportunity. But for now, the assumption should be the correction is not over and the market is looking down for targets below. And before I say goodnight, folks, we have another video coming out your way, which is earnings. It's going to be really important. Week 3, week 4. In details, the most important weeks. I spent a lot of time this week working on it, so please be on the lookout for that. If I see only half of you watching that video, which is important, it's about the fundamentals, it's about earnings, then I'm just going to quit YouTube altogether. Because then I know that it's all about zero DTEs and what's going to pop tomorrow and what's going to make me rich today. You might as well start a casino channel. But until then, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Always be closing.